by renewed tensions between Iran and the United States. And once again, these are raising concerns about potential supply disruption in the Middle East. And we know oil markets react quite quickly to escalation headlines, but not all geopolitical spikes translate into sustained moves. So the real question here is it's not whether tensions matter, we know they do, but how much supply risk is already priced into oil. Now, oil does not price fear, it prices physical supply disruption risk. So when tensions rise, the futures jump, volatility spikes, and a geopolitical premium is embedded into the price. But if the supply flows remain intact, that premium is priced back out of the market. Take our attention to 2025, and that episode offers a fairly clear template for how the pricing works. And we take a look. On June the 11th, the US threatened military action against Iran. We follow that through to the 13th of June, when Israeli strikes escalated tensions that were obviously already heightened. And we move forward to the 22nd of June, the US attack Iranian nuclear facilities, and quite importantly, Iran's parliament voted to close the Strait of Hormuz. Now, Brent crude opened above $77 per barrel on the 23rd of June. On the 24th of June, Donald Trump announced a ceasefire. No physical disruption followed. Shipping continued and exports remained pretty much stable. Prices quickly pulled back. This was a short-term repricing, not a structural supply shock. Now, to assess what is priced in today, we need to look at actual supply capacity. Now, obviously, we'll focus on Iran, as that's where the main tensions are. And Iran produces 3 to 3.5 million barrels per day. And obviously, exports are very, very sensitive to sanctions. To work back the spare capacity, well, OPEC's spare capacity, which is mainly in Saudi Arabia and the UAE, is estimated at 4 to 5 million barrels per day. And that spare capacity acts as a buffer against localized disruption. So we can see there that buffer may well cover a fall of supply from Iran. So the true systemic risk lies in the Strait of Hormuz, which carries around 20% of global oil flows. So where does the market stand now? Well, we look at most bank forecasts, and that places 2026 Brent in a $55 to $70 range, with a baseline around the $60 per barrel mark. If Brent's trading above that baseline, the difference could be interpreted as a geopolitical premium. Now, at present, market positioning appears closer to the controlled tension base case rather than a full supply disruption scenario. Now, to quantify potential repricing, let's take a look at those cases. We've got the base case, that's controlled tension, no physical disruption, and most analysts would say Brent trades roughly around the $60 to $75 per barrel mark. Then we've got the escalation case, which is limited disruption, a temporary export or shipping impacts we're talking about here. Analysts would say that Brent could move towards the $80 to $95 per barrel range. And finally, got the extreme case, which pretty much comes down to the Strait of Hormuz complete disruption. Now, that would cause a major supply shock, and analysts suggest Brent could spike into the $100 to $130 per barrel range. So obviously, we take a look at current pricing. That suggests some geopolitical premium is embedded, but certainly not an extreme case shock. Oil markets reprice quickly on escalation headlines and will and do unwind if that supply remains intact. So unless the physical flows are disrupted, geopolitical premiums tend to fade. So the market certainly appears to be pricing in some risk of tension, but not at the moment a certainty of disruption.